Hey, Kevin here, top 100 financial advisor, two-time author, one-time bestseller, and we are here to talk about the stock market. Today, I want to give you somewhat of a blueprint or a strategy for investors to give you a structure to move forward and kind of really take out a lot of the emotions and the worry and the concern when it comes to what stocks to pick, what stocks to buy, and when to buy and hold, or when to buy and sell rather, because that's a big question for a lot of us. You bought something, maybe it's Salesforce, maybe it's O'Reilly. I'll get to that and I'll tell you why I'm doing that one. Maybe it's Adobe, which I bought Adobe and it hadn't really done all that well. So I got it, but like it's April now. We're moving to a new quarter. Do I need to let go of it? Or is it something I just hold on to for a certain amount of time? At what point do I say, no, I'm not doing this anymore? I'm letting go. So I'm going to give you somewhat of a blueprint and you take it and customize it for what you need it for. And I'll give you my explanation as to why I'm doing it in the way that I'm doing it and really listen to the psychology around it. So you don't have to use it. It's completely up to you. This is your money and your investments. I'm just giving you something that has been useful for my clients, useful for myself, and that has proven to be successful. So what I'm going to do is share the screen here and draw. So y'all know my handwriting now ain't all that great, so you got to listen as I'm drawing this in case in the event that you can't necessarily read it. So that happens. All right, so here we go, blank sheet. I want to give you like that blueprint. So the way that I am looking at this is kind of in a timeline, and I've got investments that fall into each of these buckets, and a lot of this you can see on public, so you're seeing this a lot of this in real time. So I've got my forever bucket, right? So forever. So these are companies that I'm holding, or companies or funds I'm holding for forever. I do not intend on selling at any point until I'm retiring. I need to start to live off of those stocks. So in this case, this is really index funds for me. So this is ITOT. Maybe this is SPY. Maybe this is VOO, just one of them. You don't need them all. They pretty much all do the same thing. So I'm holding these for forever. I am not selling those. I'm not jumping in. I'm not jumping out. I'm investing every week, every month, every paycheck, whatever. My money is going there and it's staying there. Now, the reason why this is the case is because this is the safest money. So I'm gonna take this off real quick. Just talk to you. That's your safest money bucket. That's your forever bucket. I know, and I know for decades, I've seen this for decades. We have data all the way back to 1950 and beyond that on average, you're going to get somewhere between 7 to 10% in an index fund like that. So if I know that, I want to put as much as I can. I know, again, it's relatively safe because it's super diversified. I don't have to worry about being perfect and picking the right stock all the time. I don't need to worry about, is this the right time to invest or not? Remember, of all the stuff that's been happening this time last year, just a few weeks ago, the S&P 500, which a lot of those index funds actually hold and cover, hit an all-time high today because a lot of it is in the S&P 500. VOO specifically, actually VOO and SPY, as you can see here, are both in the S&P 500, which again hit a record earlier today. So miss me with all the like concerns, all that kind of stuff. It is one of the safest in terms of the stock market, right? It's not like cash or a bond, but in terms of the stock market, it's one of the long-term best things that you can do. It's not fun, and it don't have to be fun. If it's gonna make you a millionaire, you might as well do it, right? And index funds have proven to do that, but you've got to invest consistently and you got to invest over time. So that's my forever bucket. If you do nothing else, you're actually fine. This is your forever. This is your foundation. I'm also gonna say this foundation. What other F word can I think of? Foundation, forever bucket, financial freedom, whatever it is you want to call it, that's where you want to start. I would say, yeah, start here. And you do want to start here. You want to start with the long-term stuff first, get comfortable, and then work your way back if that's what you want to do. You don't have to do that. All right, so I've got my forever bucket. That's where I'm starting. So I've got my long-term, my index funds. I got that stuff there. I can do this through my 401k if we have this at work. You can do this through IRA if you want to. You can do this on public. You can do this almost anywhere. So I've got my forever bucket. Now I want to work backwards. So this is my long-term bucket. Say long-term. And when I say long term, I mean 1 year plus. And when I say 1 year, I mean I wait 1 year, I'll come back and reevaluate, and then it continues to the next year. So for me, stuff that falls into this bucket, this can be Apple. You already know I'm going here. Microsoft, Google. The list goes on. The names you know of. Maybe you can throw Disney in here if you want. These are companies that, again, we got a pretty good idea they're going to be fine. I'm okay. I know these companies aren't going to go bankrupt within minutes. I'm not going to wake up one day, at least in the near term future, within a year, and Disney just completely wiped off the map. It's just gone. It vanished. It went the way of Hertz. Like that's not going to happen with these companies. So what I would do, what I have been doing, so for example, it's April 1st. So April 1st, let's say I put in some money in it. I'm putting in money every month, every week. Whenever April 1st, 2022, I come back and say, all right, did these stocks do well? They probably did. Great. You get to go on to 2023. I'll see you guys later. So it's stuff I don't have to worry about, things that have performed well. I think we talked about Disney being up more than 50 some odd percent from the time we looked at it yesterday. I think that was over the last 6 months or a year. You know how Apple has been. You know how Google has been. Again, not stuff I necessarily have to worry about. I think Microsoft was up close to like 75% over the past year. So stuff I don't have to worry about. We also talked about Microsoft getting that $21 billion contract. It was 21.9 or something ridiculous. Again, Microsoft been doing that for years. So this is my long-term bucket. I don't really need to be concerned here. I got my forever bucket. I'm working myself back. I got my long-term stuff. I'm reevaluating every year and this is my strategy. You don't have to use it, but every year I come back and reevaluate these. I also, I come back and check stuff every 6 months. But again, stuff like this, they end up just rolling over year because they're that good. All right, so now I move back to my medium bucket. So this is medium, and this is 6 months. All right, so in my 6 month bucket, these are companies I think should do well, but I give them a 6 month time limit. We come back and say, okay, good. I think you're good. You'll roll up to the next 6 months. You check the box, you roll over to the next 6 months. If you don't hit your mark, if you don't do what you need to do, then you got to get up out of here, and you're not going to really graduate to the long-term category. Not every stock that's in this medium bucket gets to graduate. So in this bucket, these are companies I think will do well, that I hope will do well, that I've measured, I did my research, and they should do well. I think that's the best term. These are companies that should do well. They don't always do that. So for me, a great example is O'Reilly, ORLY. I believe is the ticker symbol there. I'm gonna pull up my app on public because that's, you guys know, I'm definitely following that 6 month trailing 6 month rule here. So I just want to make sure I'm looking at a lot of the same stocks. If you are on public, you can follow me and see the portfolio there of all the stuff I invest in right now. And I think Square is supposed to be, and it's still pretty good this year. Square is like what I thought was going to be my star for 2021. We'll see if that's the case. Stuff like Square, things like T-Mobile, which started off real bad, but actually T-Mobile is trending in the right direction right now. We'll see. T-Mobile got till June. All of these right here in this bucket, y'all got till June to be positive and hopefully beat the S&P 500 for them to continue for the next 6 months. So a lot of these I invested in June. I'm coming back a lot of these I invested in December. I'm coming back in June and saying, did you do better or worse than the market? If you did better, you move on. If you don't, you got to go. The reason is, again, the economy changes, right? What we knew back in December is different than what we know now. I didn't know what the infrastructure plan was going to be. That wasn't something on my radar, right? It is now. Now I know what it is. Perhaps I want to pivot and move more of these things in that direction. We also don't know what's going to happen between April 1st and June. There's a lot to be had. We'll see where we are with the virus, see how many vaccines are out there, see how many people go outside, see how many people travel. All of these things will actually have more information in June than what we did in December when it wasn't that many vaccines out there. You got a lot of states that are saying people 30 and up can get vaccines. You got kids, I think 11 or 12 are now getting vaccines. That wasn't the case in December. So you always kind of want to update where you are and where we think the market is going, what we know. You don't want to just guess and hope, by this time this is going to happen, this is going to happen, this is going to happen. We don't know that because when the pandemic hit this time last year, a lot of us thought, oh, by summer it'll be gone. By homecoming in October, this will definitely be gone. It wasn't, right? So you don't want to stake your money on something like that. So companies that should do well, that's where I put my six month bucket. If they are and we're right, good, you get another 6-month contract, right? If not, then look, no hard feelings, you got to go. So those are just some of my companies in my 6-month bucket. If you look on public, you'll see like just regular stocks, and then you have the long term. You know, the long term is in that 1-year bucket. A lot of the 6-month stocks are in this bucket. That's just some of them in this particular case. All right, so let's go back to the screen and move to our short term. This is what I would say my short term, my trading bucket. So short term. Now everybody has their own definition of short term. This is just me. This is that really 2 to 3 months. I'm gonna leave it. I would say 2 to 3. This is my 2 to 3 month bucket. This is like a John Deere. We had talked about that. Maybe it's a Caterpillar. What else would fall in this category for me? Maybe I'm cheating here. Maybe this is something like a Goldman Sachs or JP Morgan, because I think banks are going to do well. Maybe this is something like Lowe's that's doing really well right now, and we'll see what it's going to do, in the next 2 to 3 months in that category. So short-term bucket is, these are places where I'm trying to make money a bit quicker, right? So I've got my long-term forever stuff. I know that's going to be good. The shorter you go, the less we know about. So if you kind of look at risk, right? And kind of, get back here. In terms of risk, I'll bring it back up in a second. In terms of risk, we know that over the long term, you're going to be fine. So I know I can put a whole bunch of faith in index funds. I'm not going to make as much as I would in, say, Nike and Amazon or even Square, but I'm paying for not a guarantee, but reassurance. I'm paying for decades of results. So I've got that, right? I don't have to worry about that. Then I kind of move backwards, my 1 year and continuing stocks. I'm pretty good there. They're going to make me a lot more money. Then we go to 6 months where you're in that prove it stage. So for something like T-Mobile, they've been good for that. Over last year, they were good. Year before that, they were pretty good, but they're not Apple category. There's a big difference between the two, right? So we think, especially with the infrastructure bill, there's a way that T-Mobile can win. We did not know this back in December. We did know that the company was in a good position and that they were growing. By the time I invested in it at some point in December, it hadn't gone well, but things are trending in the right direction. Hopefully by June they make it, but we don't know that. I'm not going to sit around and wait for an entire year for them because it's T-Mobile and it's not a more established player. So but they had the right stuff. So that's where we're taking a medium risk, but a very calculated risk there. Then we move to that short-term bucket. So that 2 to 3 month bucket, these are more speculative. I want to make more money, but I also want to get out a bit quicker here. The reason why it's the case is, take Lowe's, for example. If you look at Lowe's, I think Lowe's is up more than 14% this year already. Very quality company in terms of the money they've been making, but there's a risk reward here. I'm taking on a lot more risk because think about Lowe's. They're in the home improvement space. They're primary consumer base for home improvement. So people have been home, right? That makes sense. They want to buy grills this summer. That makes sense. But they also want to travel. So what if everybody goes out and travel and they're not worried about what they're doing at the house? That's a concern. On the opposite end, I could say they got their stimulus checks. They're going to spend that at a place like Lowe's. I could also say that even though COVID, will dissipate at some point and people are going to get their vaccines, work from home is still going to be here. People are going to always want to continue to build on their homes, have a home office, a dedicated one, now that they know they're going to be at home, not for forever, but they may opt to just never go back into the office. That's something to consider, and you may want to invest more in your home. People were buying more homes and leaving big, more expensive cities. All that stuff is a real and fair case for Lowe's for the next 2 to 3 months. That's fair. but we don't know that just yet. We don't have the answer to that just yet. Something like a JP Morgan and a JP Morgan, Morgan Stanley, JP Morgan, Morgan Stanley as well, that stock symbol is MS, and Goldman Sachs makes sense, right? We think that things are going to open up in the right way. I can put this probably in that 6-month bucket. I am going to trade for Goldman Sachs. That tends to go well right now, but I'm not 100% confident in putting all of it there. And no, I can't put in the Microsoft category yet. Can't do that yet. They're kind of in that in between. So I'm gonna make some money now. Maybe they'll kind of graduate into that 6-month bucket where I'm going to give them a trial run and kind of keep them on that basis, because I think banks will do well within the first few months. I can't predict through the end of the year. I definitely don't know how they're going to do over the next year or two. We'll see. Some years banks are great. Some years they're not. So I'm gonna go back here and explain some of these other ones. John Deere and Caterpillar. These are very, very short term for me because we expect the infrastructure bill to get passed, but that's a maybe. There's a lot of argument that's going to happen over the next several weeks. I heard today on the radio that they want to get this done by August. Well, between now and August, 4 months. I don't know what's going to happen between those 4 months. I don't know what stuff is going to be out in the headlines that could help or hurt these stocks. We don't know if it's going to pass. We don't know. I do know they're both Caterpillar and Deere and Company, John Deere. They've done well over the past, year. I know they were up 124%. I think it was Caterpillar, right? That was up 124% as of not today, but day before yesterday. Things change. So I know that. I know they've been good. I know they could continue to go well. However, what happens if this infrastructure thing doesn't go through? What happens if construction doesn't pick up the way that we expect it to? That's a risk. So you can see that more risk, more reward. And I will draw a terrible arrow here. So please forgive me. Right? So risk. This is I'm a terrible artist. I got kicked out of art class because I was so bad. That is a true story in 8th grade. I'll tell you that story later. So the further I go to the left of the spectrum, the more risk I'm taking. Now I can make a whole lot more money, perhaps, because I know, again, Caterpillar did really, really well over the past year, 120 some odd percent. This got you like 17 or so. So it's, you got to pick and choose where you want to be on the spectrum. But I think most investors, you want to start here and work your way back. Get your foundation together, get your basics together, then you can move backwards on this particular scale. And that's how you build out your portfolio. This also helps you to understand when to sell, because if I'm doing something like a Caterpillar, I'm trying to get in on this infrastructure play and it works, I can say, look, I made my money for 2 months, I'm out. Or it didn't work. I was in it for 8 weeks. This was supposed to happen. Every single day I'm learning worse and worse about this bill and it's not going to pass. Then I've given it time to grow. I've given it 3 months. It's not going to work. I've given it an entire quarter, right? Because we're talking from April to July. And there's a lot that should happen between April and July, other than like July 4th. So you would have given it a full season. You would have gotten earnings. You'd have gotten a better picture of how the company is supposed to be. You've given enough time. That's when you may want to decide, all right, I'm keeping it or I'm letting it go. But that's for your shorter, more risky investments. Your medium term, give it 6 months. Now, notice one other thing. I know I'm kind of rambling a bit. Notice another thing. There are no penny stocks here. I don't think you want to go in that direction, because those are the companies that in weeks time it can blow up in your face or do extremely well. That's more of a gamble. I'm not that type of investor. You can go somewhere else for that. These are companies that none of these are going to go bankrupt within the time frames that you see here. I think that's the way I can go throughout this without being stressed, without being worried. And you don't want to be that person. You don't want to be that investor, because that's what's going to wear you down. That's what's going to throw you off. And that's what's going to make you emotional. When you're emotional, you make really, really bad decisions. I've been there and I've seen these things, and we see them all the time. We saw them this time last year. So you really want to avoid that. So again, start with the forever bucket, move your way back. I know someone asked about Salesforce. I would say Salesforce probably falls into this category. CRM. And in that, let me move this over. Probably falls in this category where it should do well. I think they were added to the Dow in December, somewhere around that time. They should do well. From December to now, they were actually up about 8% or so. A company as big as Salesforce, I'm gonna give them the benefit of the doubt. I'm gonna give them a full 6 months, and then I'm gonna decide to cut them or keep them. I don't think that they're in this bucket. That's too much of a. I don't. They're not. I don't see them as a trendy play right now, so I don't think that makes sense. And they're not necessarily Microsoft or Google just yet. They're right in the middle. So how do you decide which bucket you want to go? You want to go for? That's completely up to you. I've given you how I see it. I would say your forever, that's always going to be index funds, your ETFs, that long-term bucket, that's going to be the companies that have been around for forever, companies that we all know, like that's easy money. Those were my examples there. 6 months, these are companies that should do well. So you've done your research, and you know what my research process is, but you've done your research, so should do well, but we're not 100% sure in that way, but we think they should do well. We put them in the 6 month bucket, and then the 3 months bucket. That's the trendy thing. So last year this would have been a Zoom, right? This would have been Amazon. Could be anywhere. Maybe this is like Teladoc or something. But that was my trendy, like, I see where the market is going. Let me try this, and then you can decide what to do after that. So right now, everybody's talking about infrastructure. Everybody's talking about oil and energy and electric vehicles. That would go in that 2 to 3 month category. You try it out, see if it works. It does. Then we may move it up the chain depending on how it does. If you do it, you get your 2 months profit, you can bounce, right? That's what I'm doing with Goldman Sachs. We'll see what happens, but I'm in it. I'll be in it for at least 2 months, and then we're gonna shake out and say we're leaving, or we'll hit a stop loss and we're out. All right, so let me know what you think about this process. I want to be a little more visual and kind of show you how to structure things so that you don't have to guess and overthink and be emotional. You do want to give your stocks time to breathe and time to evolve. If you cut things too early, you're never going to really see the profit. Or you could get a small profit and cut yourself out early from bigger profits down the line. A great example for me is, again, O'Reilly. I was negative. I was down on O'Reilly since the time I invested in it. I did my research. I knew it was a great company, but things just weren't panning out up until like 2 weeks ago. And I got in this again, like back in the fall. I did a video on it. Y'all can check that video when I jumped into it. And it wasn't doing great up until recently. Now it's up 7, almost 8%. I'm going to hold it until June, and I'll make an assessment there whether I want to keep it or not. But it took time for that to pull off, right? Adobe is not doing well for me. It's fine for my son. My son is up double digits in Adobe. By the time I got Adobe in December, it just hadn't done what it's supposed to do. It was down like 14%, but now it's trending in the right direction. So when you invest, it does matter. Give your stuff some time to breathe, and also invest in quality. All the companies you saw are quality. They're all companies that you have heard of, or at least, they're big enough not to be fake. So you want to avoid the trashy penny stock. All right, so that's it for me. If you have any other questions, feel free to let me know. Put them in the comments. Make sure you hit the share button. It's the best, easiest way to pay me, and it costs you nothing. And then make sure you're on the email list and follow me on all things social media at Building Bread. All right, talk to you guys later. Bye.